3 weeks without economic data, and the market is still breaking records. In a government shutdown, corporate America became our new data source. Apple pie, Coke, and capitalism. The lights are still on, even when Washington goes dark. Here we are, 21 days in, and the economy is flying blind. We've almost missed an entire month of government data. And guess what? We're still alive. In fact, we're thriving. How is it that a market so obsessed with knowing everything is sitting at or near all-time highs? Well, we know that the labor market is struggling a bit based on 4 months leading up to September. But since the shutdown, well, we've had zero new data from the Bureau of Labor Statistics. None. And let's be honest, it's not like the jobs market staged some miracle recovery in secret. Meanwhile, investors are reaching for every alternative gauge that they can get their hands on. Gold has rocketed higher, a pure fear trade, helped by foreign central bank buying. And treasury yields, well, they've been falling, and pretty fast. The 10-year note has actually slid from around 4.6% to 3.95%, even as inflation has ticked up. That's not supposed to happen. So what gives? Well, the simple answer is this. Investors expect lower growth ahead. Long-term yields reflect inflation expectations over time. And when they drop, it's a sign that markets see a slowdown on the horizon. The economy's cooling, but it's not collapsing. If you look at what little private data we have, the story is mixed. Services are still expanding, just barely. Manufacturing is still contracting, but less than before. Small businesses are nervous. Consumers are cautiously optimistic, and housing actually looks a little stronger. That's not bad for an economy operating in silence mode. And the Fed, well, they're still talking. Plenty. The Beige Book described an economy stuck in neutral. Stable jobs, steady spending, and stubborn inflation. Translation, not great, not terrible. The FOMC minutes revealed a split committee, most expecting more rate cuts this year, but debating how quickly to move. Tariff costs are starting to erode margin, and that's keeping the Fed on edge. My friends over at Bloomberg Economics built a Fed spectrometer, and right now, out of 12 voters, 3 are uber doves, 2 regular doves, 5 neutrals, 1 hawk, and 1 lonely uber hawk. That's not exactly a falcon's nest of aggression. Fed funds futures now prices a 96% chance of a 25 basis point cut next week and a 98% chance in December. Those aren't odds, they're almost certainties on Wall Street. But here's the real story. Without government data, the market is turning to corporate America for answers. Earnings season is well underway, and that's where the real economic truth is hiding. Corporate earnings tell us everything. Who's hiring, who's firing, who's raising prices, and who's getting crushed by tariffs. So let's check in on the Dow. The Dow Jones Industrial Average, that century-old snapshot of blue chip America, just hit an all-time high yesterday. Yup. With half the government closed, the market barometer everyone loves to mock is waving the flag of confidence. Yes, its forward PE is above 20. Yes, it's expensive. But all signs point to one thing. Investors still believe in the American earnings machine. So far, 8 Dow members have reported, all beating EPS estimates by 6% on average, and 7 of them showing year-over-year earnings growth of 15%. Financials are strong, up 19% in aggregate growth. And it was yesterday's double punch from Coca-Cola and 3M that pushed the Dow to record levels. And here's the best part. Those aren't shiny AI stocks or cloud heroes. They're as old school as it gets. Nothing says America is okay like fizzy drinks and scotch tape. When companies like Coca-Cola and 3M move markets, it reminds us that fundamentals still matter. Brand endurance, dividends, and good old-fashioned profits still win. The shutdown may have turned off the government's microphone, but the private sector is still singing loud and clear. If Walmart comes out next month and says tariffs are pushing up prices, well, that's inflation data. If FedEx warns in December that shipping volumes are slowing, well, that's growth data. In other words, we're getting real-time economic signals from the street and not from a spreadsheet. And you know what? It's actually more honest. The shutdown has forced investors to listen, really listen, to the micro stories inside earnings calls. We're learning that corporate America isn't panicking, it's adapting. Some sectors are taking hits, while others are humming along. The bond market agrees. Yields are falling because investors see a softer, not a scarier, economy ahead. The next Fed cut won't be a fireworks show. It will just confirm what the market already knows. Policy and reality are finally lining up. The data blackout is revealing something beautiful. The economy is fundamentally healthy. Not perfect, not explosive, but solid. Companies are earning, consumers are spending, and markets are rewarding reality over hype. The Dow's record high isn't a party. It's a quiet nod to confidence. The system is working. Even when the dashboard goes dark, the engine keeps running. Yes, we still got tariffs, inflation friction, and political noise. But American capitalism, messy, really loud, and always self-correcting, doesn't need a referee. The players adapt. They always have. When the data finally comes back online, analysts will start arguing about basis points and jobless claims again. But we'll remember these 3 weeks as the time we saw the economy through its truest lens, corporate performance. So your truth bomb for today is this. Even in a data blackout, the American economy knows how to find the light. Join me every day for Wall Street Truthbombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truthbombs. Remember, we drop them here before the market figures them out.